Hey guys, it is Ian, and today we're going to be going over something a little more educational. And what I want to go over is using the predicting alpha terminal and the tools and features that are associated with the predicting alpha terminal for each different strategy. So today's strategy that we're going to be going over is relative value. And you guys have probably seen me use the relative value tab 100 times over in every single video that we've done. But today we're going to be talking about when we are looking for a trade or we find a trade that is a relative value trade. And just for pretext, relative value basically is how much one asset is relative to another. So, like Apple IV to Microsoft IV, the price to earnings for Apple versus Microsoft, or Coca-Cola earnings versus Pepsi earnings, etc. So, what we're going to go through today is basically how we can scan for relative value trades, how to check to see if there is a possible trade here. And then lastly, I'm just going to talk a little bit about position structuring, identifying risk exposures to different types of positions, and all of that good stuff. So let's get into it. First, finding these trades. Where do I usually go in the PA terminal to get that? Well, guys, the best place to go is correlation. And it's on the correlation tab, obviously. And instead of using a matrix, what we want to do is we want to do a finder. Okay? So we want to find assets that are similar to each other because if they're similar and they move at relatively the same clip and usually in tandem together, this means subsequently that volatility should probably be the same on them as well. So, if we're going on the correlation finder, let's just use a random example here. We're going to look up ExxonMobil, okay, and we're going to run this, okay? And what we get here is we get Chevron at 92, right? So we can say that Chevron and Exxon are very similar companies. We can also see that these companies are in the same market cap, they're in the same sector, and they're in the same industry. So it makes sense for this high correlation rate. For example, let's say we had two companies here and they were super correlated, right? Like a 0.92 is super correlated. But let's say like this company was energy and this company was infotech, right? Well, now there's a little more skepticism with regards to how strong that correlation is versus it just being an anomaly, right? Because you want to see things on a fundamental perspective too that kind of make sense. Okay? Now, I will say though that if you do find like an infotech company correlated to an energy company at 0.92, um, or something ridiculously that high, that is, it's accurate, it's right. I personally though just like for the fundamentals to make sense, right? I like comparing apples to apples, right? I do not like in relative value trades getting fancy and trying to compare an apple to an orange. I liked apples to apples. So this right here is apples to apples. So we like this, right? Now what we can do is we can go down here and use the relative value tab, okay? And what you're going to see right here is that you're going to have inputs that you can put in. You can put in four given inputs. And what I like to do is I like to put in first the short-term IV and the short-term realized volatility for both of these given companies, that whichever ones I'm comparing. And I want to get the ratios for both of them. So we turn both of these on. We get them both set to the IV30 divided by their RV30. We set the spread factor on as a ratio. And then what we do is we just run it. So if we run that, scroll down here, here's what we can see. We can see the historical IV30 or relative to RV30, aka the premium, through time, right? And we can see, for example, right here in May, just around, or not May, going into May, so like early April, we actually saw what would be ExxonMobil is the first spread. So what we saw was Chevron IV actually begin to pop way ahead of ExxonMobil, but over time, the spread closed, right? We can see it again here. We can see again Chevron IV going absolutely ballistic, and then it closed. Now, is this due to outline factors? Right? This is the part of the analysis where we need to be very sure that we're correct with. Is there any reason why we could see this? Why we could see this big spike back here? Was it really just because the market wasn't noticing that Chevron and Exxon, two similarly correlated companies, are going out of tandem? Or was it something else, like earnings? And we can actually omit that using the non-event IV30. So now let's run this and see what happens to those spreads. We still see it. So this would have been a great trade right here, right? We're basically just playing the spread. Let the spread close, let the spread close, let the spread close, etc. Now, the key here is, why we take relative value trades. Okay, why would we take something like this? Why not just go, well, this is super overpriced, so I'm gonna sell Chevron and I'm gonna, just I'm not even gonna touch Exxon, right? Boom, done. Now, we call that focusing on the alpha leg, and focusing on the alpha leg is good in some instances, but when market conditions are extremely volatile and all over the place, right? Sometimes we really don't want that broader market exposure. And by the way, we can actually see how much market exposure Chevron has to the market. So our dependent variable here is going to be Chevron. Our independent variable here is going to be the S&P 500, outliers removed. And we can see that this is a beta of 0.44. So it's not ridiculous, but I will say that a large part of why I think we're seeing a lower beta recently is because of obviously the massive run up that we saw in commodities while, this was basically just infotech, just consumer discretionary getting slaughtered. And now, we're seeing more correlation pick up recently, and you can actually see that here with the rolling correlation time series. This was like, coming down, commodity prices skyrocketing, basically actually flipped negative, and then now it's back to being positive correlation rating around 4 point or 0.45 as of right now. So I wanted to just make a point to this because what we have there is we have market exposure. And let's say we don't want market exposure, right? Let's say we're just trying to take a trade where we don't have to worry about what Vladimir Putin is going to do or what's happening in Ukraine, what's happening in South America, or wherever else around the world. This is when relative value trades come into play because at the end of the day, you're only going to lose money if the spread that you're trading against turns against you. So, for example, let's say you shorted here, right? Now, let's say you bought Exxon 30-day IV, sold, or you bought Exxon volatility basically, you sold Chevron volatility. Now, let's say they skyrocketed. As long as the spread closed, you will make money. It sounds ridiculous, but in theory, that is how these types of trades work. And, they're extremely, at least in my opinion, low market risk. If any market risk, depending on how you hedge. So they're extremely important in that regard. Really wanted to hit that portion up. Now, the next thing that we're going to look at. So we've gone through how to find possible relative value trades, how to analyze if we're seeing one. Now, what kind of position does this take? I'm making the point here we're using the short-term case, right? Well, the type of trade that you're going to make here is, like I kind of said, you're going to kind of sell straddles on the second spread, which is Chevron, and you're going to buy straddles on Exxon. Again, this is all just an example. Okay, this was back in January, February, so this is not happening in real time right now. Now, are there other relative value trades besides vol? Yes, there are a plethora of other trades besides vol. Okay, we can actually look at the skews as well, right? And skew for, maybe newer traders here, skew is essentially just, you know, how much more expensive are calls than puts. That's like the most simple way I can put into it without getting into the technicals. There's great education in the PA education tab that really goes into that a lot more in depth. So I'll leave you guys to that. But what we can see here is that, skew technically right now is overpriced, right? As a whole, I mean, if we look at the skews on Exxon and Chevron and their historical time series, this is actually pretty expensive. This might have to be something I look into. But what we're also seeing here is we're seeing this gap between Chevron skew and Exxon skew. Now, this is the second really important part here about relative value trades is if you see consistency where this is like Chevron skew is consistently above Exxon skew, there may not really be a trade here. There really may not be a trade if it doesn't really, you know, if it doesn't really mean revert, right? Now, to really see if it does, it's just like what I did before, guys. We can go in here and we can turn this on and do a spread factor over ratio and watch what happens. Now we have this. We can see a couple blowouts here. So let's just go from July to September. And we can see that, okay, there actually are some ranges where we could get short this and actually, make a decent sum of money depending on the structure of the trade and things like that. Now, skew trades can be a little bit more difficult sometimes to pull off. Okay, like you're essentially shorting the skew of one and buying the skew of the other. So the way you can think about this, like you're gonna be, let's say the skew obviously on these big companies to the put side. So what you're gonna do is a couple ways off the top of my head. You can do vertical spreads. You could vertical spread into the skew on both. Obviously you'd be long. It'd be long the skew for, in this case, Exxon. You'd be short the skew in this case for Chevron. Um, and then, you would let that play out over time. And hopefully, the skew would obviously revert back, to this range. This actually seems like pretty like fair value, honestly, like in its historical time frame. But, in this range, this would be pretty good. Another way you can do this is you can pretty much just, sell, since to the put side again here. You could sell puts on Chevron and buy puts on Exxon, right? You're basically you're selling the more expensive, you're buying the cheaper, right? And that's the major point I want to hit before we wrap this up. You Relative value is essentially selling expensive and buying cheap, right? The only difference between, relative value and trading in general is trading is in general is just, I think this is expensive, I'm gonna sell it, right? It's not, both are not happening at the same time, if that makes sense. Like I'm not selling vol on every position that I have and then buying S&P 500 vol, right? That's why, relative value makes sense in this instance and what I'm getting at. So, besides that, guys, there's obviously so many other, things that you can do here. You can, compare the term structure like the IV30, the IV90, which is essentially just forward vol. And you can compare these through time. So for simplicity's sake, we're just going to compare the 3090s real quick on these and see if there's anything in the term structure. So in the term structure, again, doesn't really seem like there's a whole lot going on. Again, this is the Exxon Mobil forward volatility divided by the Chevron forward volatility. So remember, if we go back, we saw Chevron actually had a higher skew than Exxon. And now we're actually seeing this flip in the term structure. Forward volatility between 30 DT and 90 DT is actually higher on Exxon than Chevron. But the thing is this really a trade that looks optimal? And this is where we have to use data as our guide. I really don't think it does. Considering that historically we actually see Exxon typically is trading at a premium. So it's not like, an anomaly or like a quote unquote, opportunity that we could really take advantage of. But like I said, guys, there's a million different things that you can use the predicting alpha relative value tab for. And there are, and couple that with the correlation tab, it can be really easy to find correlated assets and compare them. And you can make your own assumptions of if this is expensive or is this cheap. Now, I will say, before we wrap this up, just so you guys have this in your back pocket as well, I'll give you some ideas, is when you're taking a trade on two term structures, right? There's a couple of ways you can do it, but probably the most simple way is if you're doing like 3090. Let's say Exxon forward vol was here. right? And Chevron was still here and Exxon was here. Then what you would do is you'd actually sell a calendar spread on Exxon. So you would sell the 90 DT strike and you would buy the 30 DT strike. And then you would buy a calendar spread on Chevron. That's one way you could do it. Or another way that you could do it is you would just sell either 60 DT or 90 DT vol on Exxon, and then you would just buy the exact same strike option, equivalent, obviously delta equivalent, things like that, on Chevron. Pretty much same expiry. Because you're basically saying that if ExxonMobil forward vol is here, Chevron should be like a couple bips below it, right? So there's a million different ways you guys can come at this, guys. Really just want to show you guys again what we can do with the predicting alpha terminal to find trades using the correlation tab and then comparing these correlated assets to each other and seeing if there's anything there in the relative value tab with all the bells and whistles. So I really hope you guys enjoyed this one. If you have any questions, feel free to message me as always. And with that, I hope this little educational video and maybe a couple of tips and tricks and ideas helps you guys with your trading in the long run. And enjoy the weekend.